Good afternoon, everyone. Thank you so much for joining this webinar today to discuss with us the FCPA accounting provisions on books, records, and internal controls. My name is Leslie Benton. I am Vice President at the Center for Responsible Enterprise and Trade, and I'm joined today by Ben Cohen, who's a Managing Director in Control Risks, Compliance, Forensics, and Intelligence Practice. And I think I'll just apologize now for my voice. I'm suffering terrible allergies, so I'll do the best that I can, but you may hear me coughing a little bit through this.
Thanks, Leslie. Good to be with you.
Thank you so much. Thanks for joining us. So what we're going to talk about today, we're going to go into just a very brief discussion of the FCPA accounting provisions themselves. We'll talk a little bit about recent enforcement actions, and then we're going to get right into the meat of what kind of controls you should have in place and how to comply with the FCPA. So I'll start with a brief introduction to the accounting provisions. And I know many of you may be expert, and this will be old for you, but for any of you for whom this is a new area or you need a refresher, I'll go into a little bit of background. So despite the recent focus, I guess recent, really the decades-long focus on bribery of foreign officials, we all know that the FCPA has actually a much broader application. And in addition to the bribery provisions, it imposes on all issuers, and I'll get to that in a minute, specific requirements for implementing accounting, record keeping, and internal controls provisions in your business process as well. These provisions are designed to complement the anti-bribery provisions by making it harder basically for companies to make and hide corrupt payments. And so what that means is the accounting provisions require companies to make and keep books, records, and accounts which in reasonable detail accurately and fairly reflect the transactions and disposition of the assets of the company. And they also require companies to devise and maintain a system of internal accounting controls sufficient to provide reasonable assurance that transactions are made in accordance with management authorization and that they are recorded properly in the books of the company. As I said earlier, these provisions don't apply as broadly as the bribery provisions. They apply only to issuers, and those are companies that basically have registration requirements with the U.S. Securities and Exchange Commission. And that would include, of course, U.S. companies, but also their foreign subs and joint ventures as well, or any other company that is registered on a U.S. exchange. So some of the elements that we'll talk about really, key elements of internal controls are things like accounting and financial controls surrounding cash, expense authorizations and reimbursements, controls around gift giving, travel and entertainment, charitable contributions, controls around the selection and approval of vendors and third parties, controls around tender processes, procurement, for example, and we're going to go into detail on those as we go forward with this webinar. So again, what is covered? All activities of the company. So that means whether they actually relate to bribery or not. So they work. These provisions work independently of the anti-bribery provisions. It's also important to note that there is no materiality standard under these provisions, so that all funds must be recorded accurately, sort of regardless of the amount. And it applies to all of the registrants' books and records and transactions, not those that relate to official government business or foreign business.
And Leslie, there's actually a great recent example of this. Just last month, Las Vegas Sands agreed to settle with the SEC and pay a $9 million penalty, not because they were directly accused of paying bribes, but because the SEC found that they had really poor accounting controls in their operations in China for a period of 5 years. So what Las Vegas Sands China operations did was pay millions of dollars to this consultant in China to facilitate business. It included the purchase of a basketball team, the Chinese Basketball Association, a building that was owned by the Chinese government. It even included $1 million that was supposedly paid for arts and crafts for the building, and there was no evidence of the artwork purchase. The SEC found poor accounting controls basically because there were zero approvals or documentation of any of these payments. There wasn't necessarily bribery involved, but it shows that without the proper controls and books and records, companies can be held liable. And you mentioned also that it's more than materiality. So, for those of you familiar with Sarbanes-Oxley, those controls mostly have a materiality focus, and some of the controls in place at a company that are put in place due to SOX do translate to the corruption and FCPA controls, but it needs to be a little more in depth, which we'll talk about as we go on here. So, it's the books and records that apply to all transactions and supporting records. So it's really more than just the receipt or the journal voucher. You have to look at contracts and agreements. You have to look at other correspondence like memos and emails, meeting minutes, bids and tender documentation. All of that in sum total to the books and records of each transaction.
Right, and I think it's important also to note that, here we say that there's no direct knowledge requirement. Companies are going to be subject to penalties even if the officers of the company didn't know of the inaccuracies. Certainly inadvertent errors won't give rise to enforcement, but there is no direct knowledge requirement. So that's also important to note.
Yeah.
So again, grounds for liability, these provisions are actually enforced by the Securities and Exchange Commission. They give rise to civil liability. And what we've seen really in some ways is that we're seeing these kinds of charges being brought more and more against companies because of the burden of proof is so much lower. It's just much easier for the government to prove a civil case than a criminal case. So in almost every instance of when you see bribery allegations, you also see these books and records allegations as well. And again, they apply to not only to issuers, but their subs and their affiliates, and also for individuals, for aiding and abetting. And there are instances in which criminal liability can attach if a person knowingly circumvents the law or knowingly fails to implement an internal control system. But for the most part, these are civil charges that are brought against companies.
Yeah, that's right. Like you said, it's really tough to prove intent in a lot of these cases, so it's tough to get to the level of criminal liability. But yeah, again, the civil enforcement can be just as damaging.
That's right, and I think as we go forward, we're going to see in just a few moments some of the fines that have been imposed in some recent cases, and we'll see that they're actually quite significant.
Yep. So the reasonableness standard is important to keep in mind as you're thinking about the level of books and records and level of controls that are necessary. So the FCPA and really other laws and guidance globally doesn't provide specific controls or specific minimum requirements for books and records. What companies are required to do is keep records in reasonable detail and controls that provide reasonable assurance. So this reasonableness standard is really different for every company. It depends on the size of the company, the global reach, the resources available, their systems versus manual processes, their risk profile, and even the business model or the way they go to market in different countries. What may be considered reasonable for one company may be something completely different, even if that company is the exact same size, same industry. It all is really customized to that company's model and profile.
I think that's a very important point to note. And I think whenever we're talking about the FCPA, I mean, that's something to keep in mind, both on the accounting provisions and also on the bribery provisions. What enforcement officials are looking for is, have you taken your own company's profile into account? Have you taken your risk profile into account? And then have you devised a system that fits that profile? So it's so important for companies as they're starting to think about developing a system of controls, really to have that sort of risk assessment done first,
right?
Before they begin to really understand, because we see so many companies that put controls in place that are aimed at what are some of the lower level risks, and they're missing some of the things that are really their top risks. And in those instances, that's the first question that an enforcement authority is going to ask you, really, is, do you understand your own risks?
That's so important. And you can't just implement a gold standard best practices controls and books and records environment that may apply to a Fortune 100 company versus a company of much smaller scale that may not operate globally like that.
Right, absolutely. So these are just some examples of transactions that are often recorded improperly. And I think we showed on an earlier slide that the accounting provisions apply both to falsified payments and to off-books payments. So these are just some examples of payments that we often see recorded improperly. So obviously bribes, sometimes payments to agents aren't recorded in accurate detail. We see commercial bribes or kickbacks being characterized as something else. Also with facilitating payments, particularly in that instance, to meet the requirement in the FCPA on facilitating payments, you have to record them properly in your books and records, and often we see them recorded as something other than what they are.
Right.
Same with gifts and excessive entertainment. These are sort of some of the areas that get companies into trouble.
Yeah, and it's also, a lot of these categories are some of the higher publicity type of forms of bribery. It's important for companies to keep in mind that there are other forms of value that can be passed on, like preferential pricing arrangements, excessive discounts or unusual pricing that their third-party partners or end customers could then use those additional margins to pass on to end clients. And we'll talk a little bit about that in a recent case study.
And this is just some examples of the kind of things that we've seen from the cases, some of the violations that we've seen. False invoices paid, that's a real common thing that we see from the cases. False description of travel and entertainment or gifts. Booking a bribe as a facilitating payment. Booking a bribe as a fee-for-service payment or as a promotional expense. And then in this one, too, this last one, sort of making payments out of one sub and then recording. Well, you can sort of see it's, what am I trying to say? Not accurately booking the payment to the corporate entity that actually makes the payment. So we see some of that in the cases as well.
Yeah, and I think you can tell me if you disagree or not, but I think we're starting to see this even more lately. Just so many corporate structures have just expanded operations globally, or they're set up where there's so many more intercompany payments being made, and it's more difficult to trace where the true payment and who the beneficiary of the payment is and whether it relates to that entity or not. So it's just, again, important to have the right controls in place for those intercompany type payments and make sure the books clearly reflect which entity it relates to.
And then again, this is just sort of in getting at the some of the other controls, some of the common problems that we've seen. And we talked about unauthorized payments or off-books accounts. Payments that clearly violate company policies, and we're going to talk about some of the operational controls as we go on. Ed even mentioned in the case that you mentioned, payments without any kind of due diligence, without regard to proper authorization or pre-approval, if the payments are above the limits that the company policies actually allow, and payments that lack adequate documentation, so really nothing that you can go back to and sort of link up.
Right, and that last bullet, without adequate documentation, that's exactly what happened to Las Vegas Sands, and we've seen that in other cases as well. And again, it's really important, the third bullet there, payments without prior due diligence, I think it's something like 90% of enforcement actions involve third parties or some ridiculously high number. Yep. So, payments that are going out the door, companies need to know who those payments are going to, whether they're reputable companies, especially if they're, making sales on the company's behalf or representing the company in some other fashion.
That's right. I think I've seen at various points in time, it's been almost 100% of cases involve some aspect of a third-party involvement. And so that's a huge area of risk for companies that they need to be aware of. And we do see that in a lot of the cases. So we're going to talk just a little bit about enforcement now, and we'll go into some recent cases. This first slide that we'll show you is really just sort of a representative example of some of the cases that we've seen recently that involve these, accounting provision violations. And we put this here so you could really see the level of fine and penalty that we're seeing. It can be, on the smaller side for FCPA violations, but they're quite significant. And sometimes on the bribery side, we see fines in excess of $100 million. These tend to be typically a little bit smaller, but still quite significant for companies. You'll see there are a lot of cases from 2015 and 2016. Of course, there are others we could have shown you. But I think last year in particular was really a banner year for SEC enforcement. We saw more cases, I think, involving these provisions than we did the bribery provisions. And we don't really see that slowing down at all. We expect that to continue for some of the reasons that we discussed earlier. I mean, it's easier for the government to make its case, to meet the burden of proof. They don't have to prove intent, but also just because they're really taking it very seriously, what they expect companies to put in place, which we'll talk about a little bit later as we go on. So very robust enforcement that we don't see declining anytime soon.
Yeah, and I think too that another trend that we're seeing is that the bribe payers themselves are getting a bit smarter, disguising it in different ways. So it may not always be clear that it's a violation of the bribery provisions, but it's much more difficult to hide it from the accounting provisions because you really need the books and records to be clear.
Exactly. We'll get into a couple of examples. Here's one, the SAP case just very recently concluded, where SAP agreed to pay $3.7 million in disgorgement plus interest to settle charges that related to business that they were conducting in Panama. And if you see the next slide, we actually go into some of the findings in the case. And again, here, there was no control in place for the company to scrutinize large transactions. So no controls that really, no sort of scrutiny or approvals or sort of levels of approval in the company that sort of allowed this executive to evade sort of basic procedures that the company had in place. We also saw falsely recorded funds in the books and records of the Mexican sub. So again, here we've got a parent and sub involved in this case. And this is a really important issue here. We're seeing this if the payment comes out of the sub, but ultimately those figures are included in the parent's financial statements, you see parent-level responsibility. We saw that in the HP case as well, for example.
Yeah, and that is a tough one, especially as companies have all these different global operations and consolidation. There's not the level of scrutiny usually applied to consolidated statements. But again, in this case, like we mentioned earlier, there was this preferential pricing where extremely high discounts were paid to one of their partners. Ways to sort of get to the bottom of that even before consolidation would just to either do some type of monitoring on a grand scale to try and pick out those outlier types of commissions or margins or discounts. Data analytics is another method to look through your entire population and see where the unusual patterns are or where extremely low margins might be indicative of higher discounts. So again, it's all just ways that the controls, although they may not be material to the company as a whole in a certain subsidiary, it's really important because it all consolidates to the global level.
We have another example, the S&C Lavalin case.
Yeah, so this one was a few years ago, but it's a good example because it shows how improperly recording bribe payments within the company's books and records can also be grounds for a violation. So what S&C was doing was they were using this project consultancy cost or consultancy code for 10% of the contract value of payments to certain vendors. And then those payments would be used to pass on to end clients or to win business. So they recorded these codes, but they couldn't match those codes to any type of contract or agreement. Some of them had miscellaneous charges or just a lack of description altogether. So it's really important for the controls aspect to make sure that the services that you're paying match the terms of the contract, correspond to some type of agreement, and that everything is recorded properly within the company's books. Okay, so we'll cover a bit here how to comply to sort of combat some of these problems, especially in international operations. Leslie, we could probably spend a whole day talking about this one slide here. But a good way to really know what's going on in practice in your global operations is to perform walkthroughs of key corruption controls. So the company may have corporate policies that are instituted at the local level, but to really know if they're operating in practice on a day-to-day basis, it's worth having internal audit or somebody at the company walk through and test the controls. So this includes both financial controls and non-financial, or what we'll call operational controls. From the financial controls perspective, vendor management is extremely important because that's before payments even go out the door. Vendors need to be vetted and put in the system, and there's banking details that need to be entered and made sure that the beneficiary of the payment is the one that's actually performing the service. Vendor management and cash management, it's necessary to have the right segregation of duties. So, the person responsible for entering a vendor isn't the same person responsible for paying that vendor. Third-party payment controls, we mentioned some of this before, but you really have to have the right approval authority process in place, not only to approve the payment by the person that hired the third party, but somebody else, either in finance or a manager that can review that payment to make sure it's in line with policy. Finance's role as gatekeeper we'll talk a little bit more about coming up. The other point I wanted to make on this slide was, especially for something like employee expenses or other types of expense reimbursement, a lot of companies rely on their expense reporting system to control the process, which is fine if the system's set up correctly, but there should be some level of manual controls in place to make sure that that's operating correctly and high-risk expenses are being looked at.
Absolutely. And we have here too, cash management. That's a very important one as well. Having some controls over access to and use of cash. But really, yeah, you're right. We could spend hours talking on this. I think you've got some of the more important controls in place. But again, you're going to have to look at your own company, your own structure, the complexity thereof, whether you're centralized or very decentralized as a company, and devise these controls in a way that makes sense for you as a company.
Right, and one thing to highlight here in the operational controls, I think you may talk about this later, Leslie, too. Having the right resources in place, especially locally, is really vital because the people that are doing the work day to day in subsidiary locations need to have somebody to go to escalate issues or report issues, or even just to have questions on whether this is actually compliant. Am I recording this the right way? So having those local resources in place really helps, and sometimes a company just doesn't have enough budget or resources to have dedicated compliance people on the ground. So what we've seen is companies use somebody in an existing function like finance or legal that acts as sort of a compliance liaison. That's sort of their part-time role, but they're the dedicated person locally to go to.
Absolutely. And and I'll talk about this too later as we go into operational controls. We're going to go to the next slide where we are going to get into a little bit more detail about finance's role as a gatekeeper and just how important that is. And when I start talking about operational controls and specifically about training of finance to really understand some of this stuff that we're talking about so that they can recognize red flags, indicia of corruption, so they understand that they need to look at other than material transactions. So important. So let's talk about that for a minute.
Yeah, that is so important, and training is the best way. It's sort of the on-the-job training, giving examples of what to look out for. So if finance just simply looks for whether the approval is actually on a document and then says it's okay to go out the door as a payment, then they're not really doing their job as the final gatekeeper. Finance shouldn't just rely on the sales or the people in the field as the approval, even though per policy that may be all that's necessary. But those sales individuals may have different incentives. They may value revenue a lot more than compliance if they're incentivized to make sales. So what finance can do is just have that compliance-minded substantive review when they're looking at invoices or payments. They want to make sure that they've developed minimum requirements for supporting documentation. So this includes things like for travel and entertainment expense, having the names of the attendees at events or dinners, the names of the recipients of gifts and who they're affiliated with, the number of people that attended so they can figure out how much was spent per person, and really just having enough support to be able to determine what the true nature of the expenses are. Again, the finances really can help identify the right financial and operational compliance controls because, like we mentioned, those may be more than just the policies and controls that are already in place. They have to have sort of a spin to look at it from a corruption standpoint. And then the most important is to be able to remediate those gaps if they do find issues. There should be ways to put additional controls in place or additional reviews to make sure that they understand that there's a true business reason for these payments before they go out the door.
Absolutely, and I think as companies, when they, as you said, in the onboarding process, even if you're working with a third party, for example, if in the onboarding process you do a good job of recording, keeping the contract, understanding where the money is supposed to go, making sure you've got the right bank accounts, and matching all of those things up, really looking at invoices very closely. I mean, these are areas that we see in working with companies in this area where companies get into problems if they don't have, and sometimes it's a capacity issue, that really are just trying to get the payments out the door, and helping finance understand why this function is so important, because really they're sort of the first line of defense in terms of corruption control, because often this is the assets of the company that may be being used in a corrupt way, and so it's important for even fairly junior finance and accounting staff to have a proper understanding of just exactly what they should be looking for when they're making this payment.
That's right, and that capacity issue is a really good point, because it's not reasonable for a finance department to look at every payment and apply that level of scrutiny to every payment. So they can have sort of that risk-based approach and just look at maybe higher amounts or higher risk vendors or higher risk account types with a little more scrutiny than just seeing if the approval is in place. And one other point on leveraging finance and accounting, one of the things we've seen over the past couple of years is companies need to be especially mindful of shared service center operations, because a lot of companies are moving towards this shared service center environment to really save costs and have more efficiencies. But when that happens, you may have a situation where the finance team is in a country and they're responsible for another country's payments, and all they're seeing is the support that's provided to them without an understanding of the business. So again, it's just applying that additional scrutiny to payments that maybe don't really relate to the country that they're being booked in.
Right.
So here, we've covered this a little bit here. It's really key to keep accurate books and records, as we discussed. Again, this includes the participants for meals, the business purpose, describing the nature of the expenses accurately, and making sure they're recorded to the correct accounts. It's funny, if there is a bribe payment, nobody, at least now, is going to record that as a bribe expense. In the past, bribe expense was actually deductible as a tax deduction in certain countries, but no longer. So, again, if somebody is hiding something, it's tough to do and make your books accurate. So that's why, again, you need the proper support, which is mentioned here, includes invoices, agreements, and also all other correspondence that may talk about the nature of the transaction. Okay, so now we're going to talk a little bit about some of the, we've talked about it a little bit already, but we're going to get into some of the operational controls that you have to have in place. So we've talked about the specific financial controls, but they alone are not enough, really, to protect you as a company. So, things like, as I said before, doing a risk assessment of your company. And, when you're performing a risk assessment, you should look very broadly at all of the risks that you could face as a company.
wherever they might come from, looking externally, looking at things like your own industry, your geography, whether you do work with governments, whether you have lots of touch points with governments, you might be doing public contracting, whether you must work with third parties. We'll get into that a little bit more. But as Ben said, I mean, that's such a huge risk area for companies. But sort of taking a profile of the company, understanding where your risks are, and then ensuring that you look at the controls you have in place, and this gets to the point that Ben made, and doing an assessment of whether those controls are actually adequate to address your known risks. And I mean, that's one place that companies can sort of start looking just to ensure that they've got the right financial controls in place. They should look more broadly, of course, and look at things like third parties. If you're working with third parties, as Ben said, you need to do really effective due diligence of those parties. And that means, understanding whether they are the kind of partner that you would want to work for. We mentioned earlier that there's no requirement really in the FCPA at all that you have to know that a violation is occurring. But if a third party is making a corrupt payment, working on the company's behalf or for its benefit, that corrupt payment, the liability for that can be imputed to you as a company. So understanding who your third parties are, making sure you've done that kind of due diligence is very important. Also in this area is monitoring your third parties as well. Just as you should be monitoring your own program internally to ensure that your controls are working, you should be monitoring your third parties to make sure that they are complying with your own company policies, that they're complying with any accounting controls that you've asked them to comply with, that they are actually providing you with the documentation to support their invoices that you've required of them. So monitoring is another really important operational control that you should have in place. Training, we talked about a little bit. And I think, here you've got sort of two issues. You should definitely train your staff who's working with the third parties very closely so that you've got someone who really understands the nature of the relationship. And you should train your accounting staff to understand what they should be looking for. We talked about that a little bit before.
Yeah, the functional training is really key because a lot of companies will give the standard anti-corruption training to all employees, but finance and sales and marketing, regulatory, they all have different government touch points, like you said, or risk points. So it's important to key in on those behaviors or things to look out for in those trainings. Exactly.
And in that regard, what you should really be thinking about is that you're giving your employees the kind of training that they need to actually make their job easier for them, so they understand the risks that they might face. It's important in this case, I think you can use scenario-based training. We see some companies that give, as you said, the sort of just all-employee, some very generic examples of how corruption might occur, but not the kind of detail that actually helps an individual understand in their business function how this might arise in their day-to-day job. So you can think about using those kinds of examples. You can take examples from the cases as we have today. There's a lot to be learned from that. As a company, if you have a problem, you can use your own problems as teachable moments with appropriate confidentiality in place, or you have to be concerned sometimes with not just confidentiality, but there are some legal concerns. But I think it's important for companies to use the kind of issues that arise within their own ranks as ways to help their employees understand what they need to do.
Yep. And Leslie also mentioned the risk assessment and how that really can be such a great exercise for companies. Especially if you have international operations that you recently acquired, or they sort of operate independently of corporate, and there's not much management oversight. it's just a good exercise to get an understanding of the business risks as a whole, and then really dig down and figure out what controls and what types of books and records are actually in place at those locations.
Absolutely. And something else you mentioned earlier, and we would sort of categorize this as, one of the policies or procedures that a company should have, but that really is a mechanism to allow employees to raise concerns, to report potential violations. So that's whether it's a hotline or some companies, whistleblowing line. But you want to have some kind of mechanism so that you're getting these reports in real time from employees, from third parties, from others. Many companies allow anonymous reports as well. And it's important for somebody to be paying attention to the kind of information that comes in over the hotline, and that you're actually following up on reports, investigating where you need to, and remediating problems as you find them. This is one of the issues, and I think it's important for companies, whether you're talking about financial controls or any other kind of controls, but to create that kind of speak-up culture. There has been, a lot of research on that, and there are a couple of reasons that employees don't want to speak up. One, of course, is that they fear retaliation, so it's important to have an anti-retaliation policy in place. And the other is that they feel that it's futile, that nothing will happen if they bring a report. And that's one of the reasons I said earlier that it's important for companies to sort of, if something happens within their own ranks, when you can let employees sort of know about that, you can go back to the person, obviously, that made the report and let them know that you're following up on it. But also, so just as a general population, your employees know that you take these things seriously when they occur. Those are the kind of things that help companies develop that speak-up culture. I've also seen companies now training management to accept reports in a way that doesn't chill them. It's sort of human nature to, when somebody comes to you with bad news, to sort of seize up a little bit, but and that can really chill the environment. So
that's interesting.
Yeah, doing some training of your management to be able to receive these reports in a way that is conducive to, continuing that kind of a speak-up culture. That's very important in the company, because you want to be fostering sort of an ethical environment, an environment of integrity, and your employees are your best asset, really, in ferreting out these issues before they become big problems.
Oh no, that's right, and that's why this corrective actions and improvements, it's sort of the last block there, but it's so important. Even from an enforcement perspective, companies will run into issues. They're operating globally in some really high-risk locations. Sometimes there's just no way to prevent somebody from getting around the system. So, the enforcement agencies are, in those cases, maybe even more concerned with how the company responded to the issue, what they did to remediate, and they're actually pretty lenient when those are evidenced that they took the right actions and they have these new policies or practices in place.
Right. Absolutely. And I guess the last box of these 7 that we haven't talked about really is the anti-corruption compliance team, and it gets back to something you said earlier about having someone in place to go to when you have questions about compliance, when you have concerns, outside of the hotline and the reporting of issues, but when you have compliance questions, having someone, and whether that person is at headquarters or locally, which is really a best practice, having someone embedded in all of your units or across all of your geographies, so that that someone is ultimately responsible for these issues in the company. That's also important. It's important to have that, because as often happens, if you don't have a dedicated compliance person, whether it's part-time, just sort of part of their role, or it's their full role, then nobody takes responsibility for these issues. So you really have to assign someone.
That's right. Yeah, because people need somebody that's dedicated, so they know who to go to, who to raise it, and can see that it's being followed through on and corrected if appropriate.
Great.
Yeah.
Great. Well, I think we have left some time. We tried to leave some time for questions if there are any. And if they are not, we are happy to provide the slides to all of you when the webinar is concluded. It's also being recorded today, so it will be available in that way as well. And you can certainly get in contact with either one of us with specific questions if you have them. So thank you very much for joining us today. We really appreciate it, and hope you have a good day.
Thanks, Leslie. Thanks, everyone, for joining.
Bye.